fugitive from justice, if you're in the witness protection, or for any other reason you do not want your face out there on the big screen or your name, just right now, take the opportunity to make your screen, take your face off the screen, and if you want to change your name or whatever. And also that we may talk about specific stocks in this presentation, and that does not mean you should run out and buy them. It means that this is a great opportunity to do some research and have some fun and see if you agree with whatever the speakers have said about those specific stocks. So at this time, I would like to turn it over to our presenter this evening, Mr. Milburn Crotzer. Mel, who goes by Mel? Mel,
I go by Mel, right?
Yeah. So would you give yourself a quick intro and take it away? I'm going to stop
Sure.
sharing now so that you can share.
Sure. I'm Mel Crotzer, a member of the Southtowns Investment Club located in Orchard Park, New York. My background is in engineering and in the nuclear field. And for the last, quite a few years, I've been an adjunct professor at Canisius College. I do have an MBA, and I've been interested in investing for decades. And I'm, kind of happy to be able to share some of my thoughts here with you tonight. Let me see if I can get my slides up. Can everybody see that? Chris, are we okay here?
Yes, we are, Mel. You're on.
Oh, okay. All right. So from Orchard Park, New York, with the snow on the ground, I hope everybody's really enjoying the second day of spring. Buffalo will eventually enjoy that. Tonight, we're going to talk about discounted cash flow analysis. And let me just give you a quick background. We at the Southtowns Investment Club use Morningstar, Value Line, CIFRA to find stocks of interest. And we often, as part of the screening process, we look at the fair value. And many of our members are saying, well, what is fair value? How is that calculated? This thing called the discounted cash flow analysis. What is it? And so this was the beginning of the creation of this particular group of slides. And to do that, I have to start off with a little bit of basic financial math. And let me jump to the agenda. So a couple of slides on relatively, I think, simple financial math leading up to what this thing called discounted cash flow is, applications to annuities and bonds. And I want to talk a little bit about bonds because that forms the template for how you can value a stock. And then we do some examples. We're going to look at fair values for the Magnificent Seven, which maybe they've turned into the Magnificent Four, but we'll see about that. So starting from a concept that I think everyone is familiar with, compound interest. All right, if you put in an investment, $1,000, 7%, you get 1,070 after the first year. If you keep it in, you get interest on interest. I think everyone is familiar with that. And the formula at the bottom is the value that you would get if you kept your investment in after N years. And we're going to be using a year as the time frame, not monthly or anything else. The let's see, the present value, the concept of discounting is a reverse of what we've talked about. If I needed $1,000 next year and the interest rate was 7%, how much money do I have to put up this year to get $1,000 at the end of the next year? Well, something less, $934. And if I don't need the 1,000 until 2 years, I would discount it back 2 years. And I have another example there. But the process of discounting is you have some future value that you want, and you want to know what it is at the present. You use this formula, and the interest rate that is there is in this context is called the discount rate. And so consider a string of yearly payments over some time interval. I'm going to call that N. And you ask yourself, what's the present value of the stream of payments? Well, it's that formula. So for each payment in each year, it gets discounted back to the present. And this is the discounted cash flow model, which has many applications. So I'm going to run through a couple of quick applications just to show you how it's applied, and then make some notation changes to get to how it's used for evaluating stocks. So an ordinary annuity, let's say you want to pay yourself $1,000 a year for 15 years. What's the present value of that particular investment? And so presently $8,000, 60 and 69 cents, will get you $1,000 each year because the interest keeps accruing. And this would be the value of the annuity. And of course, if you were going to purchase annuity, you'd have to have a commission, but it would be more than $8,000. I want to spend a little time on bonds because it forms the template for what we're going to talk about with stocks. Just some basic definition. A bond is a security issued by some corporation or government. They borrow money from the public or some institutions. There's the face value of the bond, the amount that's loaned over some period of time, called the maturity date. Now, associated with each bond is what's called a coupon. That's a set amount of money that you pay each year. It's effectively the interest rate that the borrower is paying to the lender. And so we have what's called a coupon rate, which is the size of the coupon over the par value. That stays constant. And so how do we calculate the bond price? Well, we use discounted cash flow. And I give an example here of $1,000 par value bond, 10-year maturity, coupon of $50 paid each year. And it turns out that, let's assume the prevailing interest rate is 5%. So if I put all of this into the basic discounted cash flow equation, you can see what I come up with. It's $1,000, the present value. And when you go through this calculation the first time, it might seem a little bit surprising. However, in this particular case, the coupon rate is equal to the prevailing interest rate. And notice at the end, you have to pay back the $1,000, okay, at the end, but that gets discounted at 10 years. Now, the interest rates, however, don't stay constant. And I'm just going to, this is a bit of a digression, but I think it plays a role in our subsequent discussion on stocks. The $50 stays fixed, the par value stays fixed, but the interest rate changes. So if the interest rate goes up, the value of your bond goes down. and vice versa. If the interest rate falls, your value goes up. And bond dealers deal with a concept called duration, which is a measure of the bond sensitivity to price sensitivity to a change in interest rate. And I did a calculation there to show that this particular bond, $1,000 bond, even though duration talks about or implies time, it's really a percentage change to in price to a 1% change in interest rates. All right, now let's talk about stock valuation using what we talked about with bonds and making some notational, some definition changes. So in place of coupons, we're going to talk about free cash flow, okay? And that's going to vary over time. Now, in place of the interest rate, we're going to talk about a thing called the weighted average cost of capital. Big mouthful. We're going to designate that as R right now. And instead of the discounted par value, which we saw at the end of the previous formula from the other slide, we're going to talk about a terminal value. And you put this into the discounted cash flow equation, and what you come up with is the value, the theoretical value of the company called the enterprise value. And so basically that's the value of the company. And now we're going to talk about how you go about evaluating each of these terms. One of the questions I get is why cash flow and not earnings? And the bottom line is that earnings are subject to adjustments. You know, you subtract out your depreciation and amortization to get a tax benefit on your earnings. There are some other considerations. You know, you sell something and you have revenues, but you might not get paid for 2 or 3 months for that transaction, even though it turns out that you get a sale at that point in time. The bottom line is that cash is a better indicator of a company's financial health. And indeed, lenders that are going to be lending to a company want to see what their cash flow is, the free cash flow, which, by the way, is operational cash flow minus any capital expenditures that need to be made. So that's cash flow. The weighted cost of capital, let me explain it this way. You know, if you're investing in a bond, actually investing anything, you want a rate of return. There's an expectation of what kind of rate of return you're getting. On a bond, it's going to be the prevailing interest rate. Well, here, the required rate of return has to satisfy two parties: those that are cover debt, all right, the company borrows, and also for the stockholders. So each one of those groups has a required rate of return. Lenders require, okay, you need to pay your loans, and shareholders expect a return on their investment beyond what you could get with something safe like a government bond. And so what they call the WACC is that equation on the bottom, where you get the percent of debt of the company, how much of its capitalization is debt times the return on bonds, plus how much is equity and its return on bonds. Now, let me take a note here about where I'm at time-wise. Okay, so the evaluation, the return on bonds is simply your interest expense divided by the total debt and adjusted for tax, because you get a tax you get it's deductible. Your interest expense is tax deductible. Now, regarding the return of equity, what the expectation is that you're going to get a return that's greater than you would get on a government bond, and often the 10-year bond is what is used. And so, what the expectation is that you would have, how much greater will you get a return, how much greater that return will be over what a 10-year bond is. And so that is what that equation shows, and it involves a stock beta. So if you have a stock that varies widely, perhaps Tesla would be an example, okay, that would entail a stock that perhaps is a little more risky than something like, I don't know, a Johnson & Johnson, which doesn't jump around a lot. Bottom line, both of these returns are influenced by prevailing interest rates, okay? We'll get into that in just a second. Terminal value, I don't want to spend too much time on there. The question comes up, you can project your cash flows out to 5 or 10 years. I've seen it done either way. And the question is, what happens? Does the company keep going? And when it does, what's going to be the growth of that company? And so there's this terminal value that's shown with it's called the Gordon growth model. And that's one way of addressing how you close this up, assuming that the company keeps going and going. Second method, called the exit multiple method, multiplies the final cash flow, or actually what you multiply by the earnings before interest, taxes, depreciation, and amortization, by a factor which actually gives you the value, the enterprise value at the end of that time. And the assumption is that you're selling the company. And that might seem like strange, or is the company going to go out of business after 10 years? Well, no, but it turns out that this is a way that the investment professionals prefer to I guess, find an end game for the evaluation of a particular stock. Okay, we're almost there. So, having explained the WACC and the cash flows, we're almost there. We have the enterprise value, which we've talked about with its terminal value. And then the fair value of the stock would be your EV, your enterprise value, plus any cash the company has, less the debt, divided by the number of shares. And the fair value, you compare that to the market price. If the market price is below the fair value, maybe a buying opportunity. If it's above, well, maybe you better wait or find another stock. And that's the way this is used. I want to, this is kind of an important concept here. I'm going to try to take what I've just talked and tie it into our SSG, all right? And the SSG, one of the things you calculate is the compound annual return at the very end. If you compare that to a WACC, so if you in your reading, you find a company and it tells you, okay, here's our fair value, and this is the WACC that we used. You compare that WACC to your return on your SSG. Your SSG return should be greater than that WACC. I mean, that WACC is a floor, all right? That's the minimum expected return. If you're below that, that's not good, all right? Now, whether you buy or sell, that's another matter. But I wanted to relate your your compound annual rate to this concept called a WACC. And actually, the SSG preferred method simulates a simple discounted flow calculation, starting from the revenues and working back down. All right. So what I've done is I've compared fair values calculated by a number of analysts, Morningstar, Cipher, which we use. Simply Wall Street, I don't know if any of you have tried that. It's interesting. They have they calculate a fair value for all the stocks that they look at. And moreover, they tell you exactly how they do it, okay, which is kind of nice. Guru Focus, I'll spend a little time on that. They were anxious to tie me into their $489 a year program. And so I was only able to grab a couple of pieces of information from there. I didn't want to get roped in. And we're going to look at the Magnificent Seven. So here's the results of this particular comparison. Plotted on the bottom, or shown on the bottom, are the stocks that we're talking about, the Magnificent Seven. You've probably heard about that. And on each one, the blue is the Morningstar fair value, the orange is Cipra, and the gray is simply Wall Street. And what I've plotted here is the price as of last Monday divided by the fair value. So anything under 1 could be considered undervalued. Anything over would be overvalued. And I did not have a fair value for Meta from Cipra, so that's missing. But just looking at this, you can get some ideas of what's going on there. One might say that maybe Amazon is a bit undervalued as of last Monday. Likewise, Google. And if you read the news, there are a lot of people saying that Google, which is having its problems, might be an undervalued stock. Meta, at least as far as Morningstar goes, is overvalued. And NVIDIA, I think it's generally regarded as being overvalued. It's a rocket going up. And some people will say, well, they deserve to be at the price where they're at because of their sales. And of course, Tesla, by Morningstar and Cipra, might be undervalued. And of course, simply Wall Street says it's quite overvalued. Bottom line, I summarized kind of what I've been saying here in this next slide. I'm not going to go through this in great detail. The values vary, all right. And so, it probably is good to take a look at several different indicators, some fair value indicators before judging whether stock is overvalued or undervalued. Cifra's fair values are generally higher than Morningstar's, but not excessively. Simply Wall Street is kind of like all over the place. And then you compare the stocks, as I said, that perhaps Google and Amazon are undervalued. I think at this point, NVIDIA, Apple, Meta probably are overvalued. Now I compared these three stocks, Microsoft, Google, and Apple, with what I have got on Guru Focus, all right? And I was only able to grab for free these amounts. And maybe some of you, have Guru Focus, and you might understand all of these. All I know is that there's two different kind of discounted cash flow analyses. I don't believe it's the fact that their terminal values are different. And then there's what's called the GF, which is Guru Focus's, I guess, in-house method for evaluating stock. And you can see that, for example, Microsoft, which looks fully valued by CIFRA and Morningstar, uh, the discounted cash flow values for Guru Focus are, they say it's drastically overvalued, which means their fair value for Microsoft is quite low. And I summarize that here. Okay, so my summary here is that the discounted cash flow analysis has many applications, and one of them being estimating a fair value for a security for stock. The calculated fair values can vary widely depending on the assumptions made on cash flows and the WACC. And I might just add, I'm surprised it comes out so close, but generally it comes out, the calculated price comes out kind of in the ballpark of the actual market value. But I want to close by saying you got to look at more than just the fair value. You have to look at the PEs, and you want to compare your price earnings ratios, price revenues, et cetera, to other companies, other sectors. That's important. And you want to do your SSG for sure. I'm going to stop. Well, yeah, let me see here. I did a cash flow analysis for Microsoft using just the information on Yahoo and Value Line. Those who are interested, they can kind of go through this unless, people want me to go through it. And then at the end, I have my references. Okay. So I'm going to stop here and see if there's any questions. Hopefully this was somewhat understandable, trying to get a handle on what we mean by fair value.
So at this point, if anybody has any questions, feel free to open up unmute yourself or ask in the chat.
Let me ask a question. How many of the participants here look at fair values, either Morningstar, CIFRA, and do any of you use that in part of your screening?
I think I use a form of it based on the research that Value Line presents, and I believe Manifest also gives somewhat of a fair value factor as well.
Which one? Can you repeat that latter?
Manifest.
Manifest. Okay.
Mark Robertson.
Okay, I haven't looked at that.
We're getting some comments that people use Morningstar Fair Value and the SSG Plus.
Sure, you want to do your SSGs. Again, we look at fair values for screening. Our group tends to really kind of focus sometimes too heavily on what those fair values are. That's just the starting point.
Too heavily? Do you get into some good-natured debates?
We do. Yeah, we have people that want to they want to jump on NVIDIA, they want to jump on the high flyers, and there's a group of us that try to put a little more restraint on the group. But we've been in existence for 29 years, and we have healthy debates, and we usually come up with a reasonable decisions.
Even for the high flyers, huh?
Yeah. And if you look at the top 10, like in Better Investing, what's the number one stock on top? It's NVIDIA, and maybe it's justified, but it seems a little rich to me.
Yeah.
Our club is going to be looking at what else was presented in the latest issue of Better Investing Comcast. Haven't even thought much about that, but we're going to give it a look.
Good. We had a question. Where do you get the CIFRA reports from? The participant thought that Fidelity offered them, but wanted to check.
Yes, where we get our sources. Now, personally, I don't have access to CIFRA, but two of our members are able to get the CIFRA reports. That's where I obtained them. Okay, personally, I get my local library doesn't have Morningstar anymore, and so I go to the Fairfax County Library, and I can get value lines and Morningstars there. I've been told that if I go to if I become a member of the New York City Public Library, I can probably get all of these things. So
I can confirm that I get the value line reports from the New York Public Library online. It's a great resource there.
okay, yeah, I might have to sign up for that. A member a couple of years ago said that when we could no longer get our information from the local library, he mentioned that he got his from the Fairfax County Library. And so that's what I've been using. I've been actually looking at something. Phil, can you get CIFRA on New York City Public Library?
I actually can't confirm that. I'll have to look, but I haven't done that yet. One of the other participants said she can get CIFRA from her Schwab account.
Oh, yes. Oh, okay. Right. Our two members who supply me with CIFRA reports, that they have brokers, so they're able to get the CIFRA reports there.
One of the other participants said that it's their understanding that the non-residents of Virginia have to pay a nominal fee. She was thinking $27 a year for the Fairfax County Library access.
That's true. Yep, $27 a year. How about the New York Public Library? You have to pay for that if you're?
I think the stipulation is as long as you have a New York State resident address that you can verify via DMV license or something like that, there is no charge.
Okay, definitely have to look into that. Very good. This is good feedback.
Yeah, actually, a lot of the libraries these days, in addition to the research, you can download and borrow a lot of books in electronic Kindle format or whatever, and it's a great resource, to get those as well.
Yeah, for sure. Yeah.
How long have you been using the discounted cash flow and some of the analysis that you're presenting? Is this developed over time or use just a fair number of years?
Well, actually, I did a lot of this a few years back when I was getting my MBA. And so when I started getting questions about what is a fair value and how it's calculated, then I had to dust the covers off the books and go back and put this together.
Hmm.
I should also mention, one of the references is what I think it's called a deep dive into discounted cash flow, presented as a special presentation by Sophia. Let me see if I can. Sophia Batella, Better Investing Special Program. So if somebody really wants to dig into this, and what she does is she goes into the all of the reports, the reports that companies have to give to the government, the income statement, cash flow statement. She goes in there and does it in great detail. So what I've tried to do is present something a little bit not so deep or so detailed. But those who want to get more information should take a look at that. This is on the Better Investing list of videos, okay? And then Investopedia, if you want to know the meaning of a term or something, this is pretty good. It goes into some detail. Certainly, it goes into detail on what the terminal values are. This was the book as Equity Asset Valuation that I used when I was in college. And well, actually, both of these books are books that I've used. So
We actually had Laura, it sounds like, is from the Florida chapter, and she said that Sophia Patella is part of her chapter in South Florida. Good person to have in your chapter.
Yeah.
Okay. At this point, is there any other questions? We can open up the floor to investing related, SSG related, general comments, conversation, comments, anybody that would like to make?
Well, if not, I'm going to stop the share. Let me know if I should do that at this point.
Okay. Yeah, I was I was offering up if anybody in the south or the west coast with the nicer weather can send some of their nicer weather up this way. We're kind of enjoying mid-30s this week and getting dusted with some snow. So
Well, spring will get here, I'm sure, in due time. I mean, Buffalo is notorious for its snow, but actually, this has been a very mild winter for Buffalo. We've been out the parks in February when it was 60s, so it's been very unusual. And of course, Buffalo will also be will experience the eclipse. I don't know where everyone else is, but we'll have a total eclipse here, and so we're preparing for that. And Canisius College certainly has programs there to, I guess, in case the weather's inclement, which is highly likely. Okay, the point is we're going to have a party anyway. We'll experience the darkness, and there's a whole bunch of other things you can experience in a total eclipse. So, and then safety is very important if you do have a nice sunny day. So I wrote an article. I just submitted that today, covering what people need to adhere to protect their eyes
Proper eye
whenever.
covering, and I heard even with the cameras, you have to watch it with the cameras because that'll unprotected that may blow your camera sensor as well.
Exactly. And I got my uh, Eclipse glasses on Amazon, and what came with that is a camera filter.
Nice.
So you want to make sure you have your camera filter. It tells you which side to put. And some other precautions is I don't know. Will you be just partially eclipsed, or will you be in the path of total eclipse?
I think we're right in the path with you, upstate.
Okay. Okay.
So Margot shared that Southern California is freezing currently. They have 67, and I'd offer up if you I'll take your 67 if I can send you my 35.
There you go.
Atlanta's got some 75-degree weather. That sounds pretty nice too. I don't know if anybody saw the announcement today, hit the news wire that is there any Chipotle stockholders in the audience tonight? Apparently they announced a 50-to-1 stock split, first one ever.
Wow.
It's upwards of the right symbol. Is it CMG? CMG. Upwards of $2,900. So after the split, it's going to go back down to about $55 a share. So that'll be nice. I think that's happening in June. So it jumped about $100 a share today, it looks like, on that news, which is always kind of funny because if you've been with Better Investing for any amount of time, whether you've got one share, you've got 50 shares, it's all the same numerically, right? But
Yeah.
okay.
I haven't looked at Chipotle. Is it, uh, I mean, is it a stock to study by any chance, or has it ever been a stock to study?
I don't know. I know some people are very proponents of visiting Chipotle and their food they offer. I actually it's not actually on my radar recently, so I was gonna have to take a look into it, but it looks like it's fairly rich right now, especially at these prices. So it'll be interesting to see how if anybody wants to study it, how it comes back. Oh, all right. Great information tonight. Chris, I don't know if you wanted to tie things up here, or make the comment that with one of the questions asked about the slides. And Chris replied in the chat that the slides will be available on the website in a day or two. And the recording should be posted to the Facebook site.
Yeah, it's actually live streaming on Facebook right now, and it stays there. It continues to live there, so you can always watch the recording again. And then the recording and the slides go on the Better Investing website page. And also, if you register for this event, which you obviously did because you're here, you should get an email with the link that tells you um, where you can find the recording. And it also goes out in the newsletter. So if you are not already subscribed to our newsletter, you can put your email in the chat and we will put you on the list for that. And then you'll always know what's happening with the online chapter education committee open forums.
Brian reported that he did a quick check on First Cut and he did not find anything for Chipotle out there currently. So if anybody wants to make a study and post that to First Cut, that'd be great.
All right, great. Well, if there are no more questions, I just want to thank everyone for coming. Thank you so much, Mel, for your great presentation. When I saw the slides, I thought, oh my God, this is going to make my head explode. But you made it so easy to understand and so clear. I really appreciate that. I guess I can come on camera to wrap us up. And
Hey,
thank you, Phil, for handling the Q&A section. And thank you all for attending. Have a fantastic week. Remember that we always are here on the third Wednesday of every odd month, 8:30 p.m. Eastern Time. And now that you've registered, you should get reminders about that. But if you have any suggestions or any speakers who you'd like to see in the future, we'd love to have you. We'd love to hear them. Let's give Mel a little virtual round of applause. If you want to come off mute, you can all clap for Mel.
thanks. Thanks, everybody.
Thanks very much. Appreciate the presentation tonight. All right, everybody stay warm and we'll see you in 2 months. Thanks all.
Excellent. Thanks all. Bye.
Good night, everybody.
Night.